All right, folks, this is being recorded. Something I mention at the beginning of every single webinar, like a broken record, is watch this again. Maybe not necessarily this long call calendar, but one of the ones that I've done on the long call calendar, because you guys drive the content while you guys ask questions and I'm answering it. We're really digging into some of those nuances. So we might have dug into something a little bit differently in another webinar that might help these concepts stick with you a little bit better. So whatever it takes, try and watch one of these videos again that I've done, because it will make it stick into your long-term memory. And that's really what I want. I don't want you guys to have to learn this stuff. My goal is to get you guys to understand these options intuitively, where it just makes sense when you're looking at it. You can immediately see the red flags when somebody else, on mainstream media might be throwing out an option strategy that doesn't fit these guidelines that we're going to be talking about. You know that there is a major problem with their thesis, if you will. All right, so this is going to be on the long call calendar, and there are certain situations where I love this strategy, and we're going to talk about those types of nuances today in this webinar. It's not every day that I put on this strategy, but right around this time of the year is really where I like this strategy, and we'll talk about that, like I said. But let me get a couple things out of the way really quickly. As you guys may or may not know, I've done stuff on mainstream media where I've talked about the economic data, geopolitical environments, and how that all comes in to impact the markets with some of my market analysis. So I've been trading over 25 years now, and I started out trading in college with some money I'd earned, moved to Chicago, jumped into the pits of the Chicago Board of Trade, and traded everything from stocks, financial futures, commodity futures, currencies, and options on all those products and more, and just about all market conditions. All right, so with that out of the way, I guess we're going to be doing this, like I said, on the long call calendar. Again, I want to approach this webinar as if it were any given day that we were trading. And the reason why I throw the roadmap in there is to kind of get you guys the idea that we're following along this path, and there are different forks in the road, and we need to know when we need to go left and when we need to go right. And that's exactly what I'm trying to hammer out in these webinars. But before we get there, we don't ever go into a given day and say, I need to put on a calendar today, and how can I do that? Well, no, what we do is we kind of flip through the charts and stuff like that and find a directional assumption for some given underlying, and then that will finally lead us to the optimal option strategy for that assumption. So I'm going to kind of play it out that way. So what we're going to talk about today, and when we talk about this roadmap, what we're going to be talking about is direction. This is our assumption, right? This is the assumption. This is our assumption, our directional assumption, bullish, bearish, or market neutral, right? Our destination is really just that underlying. Our destination is this option, is XYZ option tradable, is ultimately what I want you to come up with here. Tradable, I am probably one of the worst spellers in the world, so I might misspell something here. And the environment, we're just going to be talking about volatility. I saw somebody, volatility. All right, volatility, yes. Volatility duration is just going to be time, and our strike locations. We're going to nail down these strike locations. That's key, because most people won't give you the duration. They're not going to give you what strike you should be looking at for any given underlying at any given time. And that's exactly what I want to do here with these webinars. Not only are we following this path down the road to finding the right option strategy, we're also trying to make sure that we are staying safe and picking the right strikes. That is something I'm going to be talking about specifically in this webinar. Most people aren't going to do that. They're going to just kind of say, do the at the monies and things like that. Well, I'm going to be talking about specific strikes that I like to use to try and turn that table of probabilities in my favor. You cannot see me or anything I'm displaying. Can anybody not see this? I looked at the what I was showing here. Is it not showing a what I'll show you today, Mary? Is anybody else getting this particular page here on what I will show you today? Before I start moving on, because it looks like everything's working on my end. Anybody else jump out there before we move to the next slide? All good? Mary, are you still having issues? What I'll show you today is on. Yes, okay. All right, Mary, if you're having trouble, maybe log off, log back on. I say that for anybody that if you lose sound, audio, visual, any of that stuff, it's usually on GoTo's platform. Log off, log back on. Things should be much better, but this is what we're going to be looking at today. But before we get into that, we need to go. Okay, audio is good too. All right, fine. Thank you very much, Jeffrey. All right, so before we get into that, before we take a road trip, we need to understand what we're looking at on this roadmap, right? And we have a roadmap key here, kind of similar to what we would find in the option montages, our roadmap key. Really, what this is going to tell us is what the strikes are, what the underlying is doing. And these are some of the nuances we really need to look at and understand. So I think I've got some really simple ways for you guys to understand these Greeks. Don't run away right now. Yes, I am talking about Greeks, and I know that's when people usually shut off their brain, but this is going to be really simple, all right? Delta on the floor, we used to call it data. And in this webinar, I'm only going to be specifically talking about the effects of the options premium in relation to what the underlying is. I might sprinkle in some of the other things that data tells us throughout or that Delta tells us in the form of data. But right now, I want to simplify it and talk about how the options premiums are going to be reflected in that underlying move. And when we're talking about all of these Greeks, we're talking about like an increment of one, all right? So $1 move higher, $1 move forward, or 1 day forward, all right? All of this is advancement. It's a plus. The first assumption is the plus one of something, right? Whether it's plus 1 day, plus 1 percentage point, plus $1, okay? So if the underlying, and I specifically got this out because I don't want people to be confused with, XYZ being, ABC. They're all the same when we're looking at this option montage. And when I'm talking about the option montage, that's the location, that's the screen that has all of the option information, pricing, the delta gamma, the Greeks, all of that, right? The calls and the puts. Now, when I'm talking about this, I'm talking about a $1 move. And we can see that this last on XYZ was 148.35 up here, right? So $1 plus $1 on Delta would move this to 149.35, okay? So we've got $1 move higher. Now, we're looking at Delta in this particular one. So we look down at Delta on the calls and the puts. So puts are over here, calls obviously over here. Now I'm taking a look at the calls for right now, all the way over here. If I look at the corresponding delta for the calls, it is a positive delta. So that would go on first dollar move higher. We would then see, sorry, my pen doesn't want to work for me, would see our premiums increase by the corresponding delta. This moved up by $1 up here. Our underlying is moved up by $1. Now our premiums will move positive on this side for 45 cents. So we would see after $1 move higher in the underlying, our premiums would then be $4.05 and $4 at 45 cents here, $4.20. Okay, so we could assume that our premiums would increase on our corresponding strike. All right, all the strikes would be that corresponding delta. Okay, so in this case, a dollar move higher, this corresponding strike, the 165 strike, would move up by 7 cents down here, all right? So they all move in concert with their corresponding delta. Now, notice over here on the put side, our puts are all negative deltas. They're negative deltas because the assumption is a positive move. And if we have a positive move higher by $1, our deltas are negative. So these premiums would decrease by that corresponding delta. So they would go down in value as the underlying moved higher. Now, flip side of that coin, if we were to move negative, the underlying moves down in value. Then a negative move, a negative dollar. So if we had a negative dollar move or a negative move, right, in the underlying, that would make our deltas become negative, okay? And if we had a negative dollar move down here, a negative plus a positive, then that would equal a positive delta, okay? Does that make sense for everybody? If we started moving down, these deltas become positive and then would add into those premiums as the underlying goes down, okay? So think about it that way. Positive, it's all considered positive moves. But if something negative move happens, then, or something negative happens, we have to adjust our deltas for that. Now, if we're looking at gamma, gamma just goes with delta. That's the easiest way to think about it. And when we talked about it, this was dollar number one, right? We talked about that first dollar move, what happens to our premiums. Well, this is what happens on dollar number two, all right? So if we were to move higher by $2, so now we're at 150.35, so that's plus $2, right, total. Now, on the first dollar, we already saw what happened to our premiums over here. On the second dollar move, we got gamma, which is all covered up here. This is gamma in this column. I'll just rewrite it. Gamma is here. So the gamma goes with delta. So on that second dollar move, it goes in there. So we would look at 48 cents, right? 3 plus the 45 is 48 cents going into these premiums, all right? So in that case, then we would be looking at $4.53 and $4.68. All right. So on the second dollar move higher, if it had moved up by $2, we could assume then our premiums would be this. All right. And on the flip side, gamma is always positive. So on the second dollar move higher, we would only lose 38 cents out of these premiums. Or 35 cents, right? Second dollar move higher, first dollar, we would lose 38 cents. The second dollar move higher, we would lose 35 cents. All right. On the flip side, if we started going down, that second dollar move down, our premiums would then increase by 41 cents, right? Does that make sense? I don't want to lose anybody there right away, right off the bat here. But gamma goes with delta, and it's simple math going into that, all right? Think about your dollar moves higher. That's the assumption. If it starts going down, that's where you kind of got to think, all right, well, I've got a down move plus a negative delta. That makes that a positive delta, all right? And then gamma goes with delta, however that works out. You're going to have some parentheses there or something, right? All right, so that's gamma. Gamma goes with delta, and it's on that second dollar move. All right, theta is our thief. The thief in the night that comes and steals our premiums, all right? Theta is the thief. Every single night, that theta is going to come into the markets and steal our premiums. We can see the line over here. So this is 1 day forward, right? The assumption is we move forward a day. We can see that theta in both columns is negative. And that's because we can't go back in time, all right? Every day, our premiums are going to erode in the options, all right? So something to note, we would see that tomorrow we would wake up and these premiums would lose 6 cents. Obviously, this one is only going to lose 1 cent. Over here, we can see the theta column. These at the monies are going to lose 6 cents. These will lose like a penny, okay? Now, the closer to at the money, theta is at its greatest, all right? So in any one given month, we're looking at 36 days to expiration in this particular example. So the ones that are closest to at the money, right, basically in and around here, are going to see the ones that lose or are subject to theta, all right, or the thief picking your pocket. Now, further out in time, all right, we're only looking at 36 days to expiration. If I was looking at like 200 days to expiration, theta is very minimal. So not aggressive out the time horizon, But the closer and closer we get to expiration this way, theta is very aggressive. Theta is going to be huge inside of 1 day, inside of 8 days, 7 days, very, very aggressive, okay? So we have to be mindful of that. We don't want to be getting ourselves into a situation where theta is eating away at our premiums like there's no tomorrow. And that's what happens the closer we get to expiration. If there is no tomorrow, those premiums are dwindling quickly, okay? So further out in time, not as aggressive, closer to expiration, very aggressive, all right? And the at the monies are always going to carry a higher theta value, all right? The thief is really aggressive at the monies. And then Vega is volatility, all right? When we're talking about vol, I usually will just write, or volatility, I'm just going to write vols, but we know Vega is the measure and change in volatility, all right? So just think of Vega as vol, or volatility. And what we're talking about is we got Vega over here, and this is implied volatility, all right? So implied volatility is lined up here. So we're talking about an increase of 1%. So we go plus 1% increase, and our value is 27.57, all right? So it's increased by 1 percentage point. Our premiums for the Vega over here in this column, and the Vega in this column, that 1 percentage point increase, you can see Vega is positive, it goes in. We add it into those premiums. So Vega is going to add into the premiums if nothing else changed even. If just that percentage point increased by 1%, then we would see 1 percentage point, I should say, not 1%, but that percentage increases by 1 percentage point, then we would see all of our premiums adjust according to that Vega coefficient, all right? So let's review a little bit here. The at the monies for Vega is bigger, right? We can see that happen right here. We can see the Vega is bigger on the at the monies. It's also going to affect further duration options more than the nearer duration options, meaning the Vega coefficient here is larger further out than it is closer to expiration. All right, so the idea here is, how do we take advantage of these things? Theta, if you want to take advantage of theta, then you would probably want to sell premium and have theta really erode, be on your side, right? So you're going to be picking closer to expiration type of strategies for selling premium. And when premium is really cheap, then you're going to be leaning towards getting out there the further duration. Why? Because you limit theta decay. And two, you take advantage of that volatility expansion. So buying options, you're thinking, I need further duration, avoid that thief in the night. You don't want to swim upstream in the rapids. And that's really what you're doing when you're trying to buy options inside of 35 days to expiration. So we want to limit that. We would think further duration as well, all right? So buying, the best way to really buy options is further duration, because you get volatility expansion and you get limited theta decay. When you are selling premium and volatility is high, you want to take advantage of everything that can go in your favor, and part of that is theta, so you're leaning toward nearer duration options, okay? That's just in general. Those are, some of those things to get those levers and pulleys going, so that when somebody goes in there and goes, yeah, I bought calls, 8 days to expiration, you got to be thinking, why? Why would you be swimming upstream in a 4 rapid? All right, so back on the shelf, the long call calendar, put that back on the shelf. Forget about it, because what do we do? This is really where we set out on our journey. And we are looking, where are we going to go? So what I mean by that is when we're looking at an underlying, we come up with some kind of directional assumption. Now, let's just play, hypothetically speaking, that I'm looking at Goldman for whatever reason. I'm just flipping through the charts, and all of a sudden Goldman pops up. I see they just knocked earnings out of the park, $12 earnings per share that beat the street by $5. They beat the street by $5 and the market took a tank. right? All right, well, I think that this kind of an environment is obviously very good for Goldman Sachs for whatever reason. And so therefore, I believe that earnings are out of the way. We don't have anything to worry about on a binary event, kind of, putting a jigger in this really. Yeah, we do have to kind of worry about interest rates and stuff like that, but I'm not too concerned about that. But just giving you my theoretical assumption, I think what's going to happen is Goldman's going to kind of settle down in this area, and then heading into the next earnings, I think that they're going to do very well and maybe start moving to the upside. Okay, so in the near term, I'm a little bit bearish to market neutral. I don't care if it does something like that. A little bit bearish to market neutral. Somewhere in there is kind of where I believe the market will kind of trade for at least the foreseeable future, and then start breaking out in a couple of months. But I do think we're going to settle down there. It's had a nice big run. That usually leads me to have a little pause and think, all right, well, maybe there's a bit more of a correction coming. I can't believe the street took into account a $5 beat on an earnings there. So I do think that, the risk is to the upside. All right. So that's what I'm coming up with for this type of directional assumption. So when I'm looking at my roadmap, I'm going to say long-term bullish, but near-term, I'm kind of neutral. Near-term, I'm kind of neutral right now. I think it's going to kind of trend sideways, but down the road, I think we're going to see some movement to the upside here. I'm not too concerned about the downside necessarily, but I do want to avoid it, obviously. But for the most part, I think near term, we're pretty neutral. So when we're talking about this, I'm thinking, on my roadmap trip, I'm kind of going to go like this along here. And then, my options, my short call expires. And then that's when I want to see this market start really making a move to the upside. So, next thing I need to do, all right, I've got my, line plotted out of where I want to go. Now I need to figure out, do we have a good destination? Remember when I was talking about this, this is, what I mean by this is Goldman Sachs a option or a stock that has good tradable options? All right, so that's what I mean by, do we have a good destination? And, it's kind of like when you're talking about a roadmap here, we're thinking, well, do I have a good destination? What does that usually mean? It means, is there points of interest? Are there a lot of eyeballs, a lot of people at that place? That means there's usually a lot of things going on, a lot of things to do. So I need to make sure that does Goldman Sachs have a lot of open interest in the underlying? And a quick, easy, streamlined way to figure this out is to follow this idea of how can we discern whether or not there is a lot of open interest in Goldman Sachs. Yes, you can click on this little button up here and do the drop down window, flip over to it, all of those things. But when we're flipping through the options and your watch list on a daily basis, that's a little bit monotonous to go back and forth with that. I'd rather just start clicking on it, flip over here and easily figure out if we can trade options around it. So what my rule for this is, Goldman Sachs we can see it's a $289 stock. What we do is we take this decimal and we move it 3 places to the left, all right? So that would equal basically 29 cents, right? 28 to 29 cents. It's right in there, I could call it 29 cents. So I need to take this number and look down here in the options that are, closest to 35 days to expiration. So this is the spot month. We want to look at the spot month, all right? And that's usually where volume and open interest is concentrated. Now here we can see it's 30 cents wide. Here we can see it's about 30 cents wide. Here it's 20 cents wide. Here it's 20 cents wide, right? And same thing over here. We can say, well, that one's a little wider, 40. This is 35, 25, and 20, 25. So it's kind of fitting and it's kind of a little bit outside of my rule. All right. So when we're looking at this, let's just drill down on this a little bit more. So we can say that we move the decimal 1, 2, 3, and we've got 29 cents. So we're looking at here. So what I want you guys to think about here is, correlating it to, the whole roadmap theme is we've got all right, you don't want to write for me? What's going on? Stoplight idea. All right, so you got your stoplights, and basically, if it fits my rule, which is move that decimal place, right? Fits the rule, this rule here, then that's a green light. If it's 2 times the rule, that is a screaming yellow light. Like, start being very cautious. You want to have a higher risk tolerance. It's 3 times the rule. I would say just don't even trade options. I don't even trade options around those when I've been trading for 25 years. I don't want to deal with that. I don't want to give up all that edge to get in and give edge to give out. I'm not really one to have the patience to do that. So we could actually say this one's kind of like right inside, in between those two, right? It's like a green light going to a yellow light. It fits it sometimes, but not all the way across the board. So I would say it's kind of a greenish to a yellow light on this one. If we were looking at something that is less than $100 stock, so for instance, Merck, not probably something everybody is constantly trading, but on a stock that is less than $100, if it's less than $100, the stock, if XYZ, let's just say, is less than $100, and we're going with our stoplight idea, then, less than 10 cents is what is good to go on stocks that are less than $100. So that's the rule. We've got a yellow or a green light. Again, 2 times the rule is a yellow light, and just stay away from, especially under $100. If it's 30 cents wide, just get away, walk away. That means nobody's in there trading. But we can see that this is fitting the rule basically for a green light. All right. So we can see that these are fitting that rule across the board on these options closest to expiration. Right around, like I said, that 35 days to expiration is what we're looking at for this rule. Now, when we're looking out on the time horizon, further out on options, all right, further expiration options, it's not always going to fit this rule, all right? There are less eyeballs and open interest out there further on the time horizon. But what we know from looking at the ones that are close to expiration is that this roll is going to happen. People are going to continue to trade this underlying even further out in time, but maybe just not yet. They're keeping an eye on it. There's spreads out there. There's calendars. There's diagonals. There's all kinds of things out there that you might not be seeing that's actually really tightening those markets up. We used to say they're in the weeds, or there's spreads out there that are not necessarily being represented in the market. And I don't have a whole lot of time to go over that, but I'd be happy to talk to you guys about it some other time. Maybe when we start doing our live chats. But just know there's volume and open interest in these when they fit my rules for that. So you don't necessarily have to flip back and forth. Any questions so far? All right, what's the environment? Remember we were talking about this is vol, right? Volatility. Well, we can think of volatility when we're doing the roadmap as when there's no volatility, everything's rosy, right? There's no fear driving. You don't have to worry about your depth perception. You don't have to worry about flat light. You don't have to worry about how far you can see. Roads are wide open. There's no inclement weather. But when volatility starts creeping in, that's when you start white knuckling it. Same with the markets. When volatility creeps in, people are white knuckling it a little bit, right? They're a little bit nervous. And same thing happens when you're driving. If it's rainy, snowy, people's tensions start rising, and that's where you feel volatility. So when I'm talking about volatility, I always have a chart down here at the bottom, and this is implied volatility again. Remember on the option montage page, That's what we were talking about, that implied volatility number. And this is just a charting of that implied volatility on a daily basis. So what we can tell by this is volatility, implied volatility, usually for each underlying has a pretty defined parameter that it likes to, feel comfortable in. Now, every underlying has its own implied volatility, all right? And so we have to narrow it down to each underlying. I'm not talking about VIX. VIX gives you the idea of the broader market's volatility, but what we're drilling down on here is this specific underlying, all right, that I have a directional assumption with, right? I'm going through the steps here. So when we see that they're usually get tied in a range bound, and some of you might be saying, well, look at this over here. You're not even taking that into account. No, because I think that that's more of a black swan event. Last time we saw volatility spikes like that was back in 1987, I think it was. And before that was like 1929. So anyway, too far back to really bring into a data set every single month, especially when we're only doing a couple months out. If this isn't going to happen for another 5-10 years, I don't want it to come into my thought process when I'm only doing trades for maybe 3, 4, 5, 6 months out. And I don't think that we're going to see that super low volatility we saw back in basically 2019, right, or right before the pandemic happened. I think we're going to see some elevated volatility for the foreseeable future, but I don't think we're going to see those massive spikes we saw back during the height of the pandemic or the very beginning of that pandemic. So what I want to do is just kind of get myself, a range here or a channel and figure out whether it's high or low. And I can see where it currently is compared to where it's touched down on the lows in the past. It's pretty darn low. It's nowhere near this high. So I would be able to say, pretty safely that we have low volatility across the board. And why does it matter if we have low volatility or if we have, some high volatility? Why does volatility matter? Because when volatility is low, we could see from this chart, when volatility is really low, we could expect it to start moving higher. And when it's this low, I would expect it to start moving higher, right? So if I expect volatility to move higher, that means as volatility moves higher, our premiums go up. All right, they go up as that volatility expands. We showed you how by 1 percentage point move, that volatility expands. Well, and when I talked about increments of this moving, we can see here that it basically in one day going from basically this point here to this point here, that's 5 percentage points. Okay, something like this volatility coming out, going from basically 55, 56 down to, let's call it 35. 20 percentage points, right? So you can see that volatility doesn't just move necessarily in increments of 1 or 2. Sometimes we see those increments move, 3, 5, 10 ticks at a click. All right. So we can see that volatility come in and out rather quickly. And remember, if it moves by 1, we were talking about what? 10 cents going into the premiums. That's 1 percentage point. 5 percentage points is 50 cents going into those premiums. Okay. And vice versa coming out, that's how it's going to affect that premium. If volatility comes out of this, then our premiums go down. So we want to set ourselves up for a situation where we can get in to buy when volatility is low and get in to sell when volatility is high, because when volatility is high, we expect those premiums to be very expensive, right? So effects on pricing, when volatility is high, you need to think we need to sell premium. And when volatility is low, we need to think that we are buying premium. Being that we're doing it, when volatility is low, we're doing debit spreads. And when volatility is high, we're doing credit spreads, right? Or credit. We want a credit here and a debit here. All right, buy for a debit, sell for a credit, right? To be more specific. So let's go back down. And for some of you guys, I have no problem with you kind of ballparking it. The idea here is middle of the road is basically a 50 percentile. Right now, we can see volatility is extremely low, and we buy below the 50 and we sell above. So, you'd sell above that line in the sand and buy below the 50 mark, okay? And I'll show you how to figure that out here in just 1 second. So let's zoom in on this. So we can see this is the high point. We can see basically this is the low point, and right now this is the current. So if you are a devil to details and you really want to know how to find the minutia, what we do is we take where the current is. I see your question over there. Let me give you 1 second. The current implied volatility is, which is just this number, right? Current implied volatility minus the low, all right, IV. We take that sum and divide it by the high, IV minus the low IV. Right? So basically what we're doing is finding out where this number is. We find out where this number is here in relation to the high and the low. Okay? So that's ultimately what we're trying to do here. So if I said the current was 31, right, minus the low is 30, and we take the high, which is 60, minus the low of 30, and we take those sums. So basically, actually at 30, so basically it's 1 over 30, and that is what, 3 percentile? Anybody got a calculator up? I can do it real quick. So basically we're looking at 1 divided by 30. Yeah, so it's 3%. So it's in the 3 percentile. So very low. My rule here, like I said, if it's greater than 50, you're selling premium, you're selling for a credit. And if it's less than 50, you're looking less than 50, you're looking to buy for a debit. Sorry, that wasn't very good. If you have lower risk tolerances, I have no problem with you kind of thinking this way then, and say if it's less than, greater than 70, then you're looking to sell. Lower risk tolerance people, all right, or newer traders, less than 30, then that, less than, Eric, you're getting all wacky here, trying to read comments and continue to go, then you're looking to buy, all right? So obviously the 3 percentile is a definite screaming buy, all right, for premiums. No matter what your directional assumption is. I don't care if you think that I'm off my rocker with my directional assumption or whatever. If you knew that the premiums are this cheap, you got to be thinking, I need to do some type of debit spread, based on whatever your assumption is. I'm just coming up with my theoretical assumption here, right? So I just know that with premiums this cheap, I have to be thinking I got to be buying. All right, so in Goldman Sachs, we are looking for volatility expansion as we get to earnings. David, you are so far ahead of the game right now. You're killing me. You're killing me. No. Yes, exactly. We are looking for that volatility to start expanding, because then our premiums go up, even if the underlying doesn't move. If that volatility starts increasing, we start making money, even if the underlying doesn't move, because our premiums will start increasing if volatility increases. Okay? All right, so what's the duration? I already told you we already have low volatility. If I have low volatility, what do I need to do? I need to lean towards buying premiums, right? If I have low volatility, I'm leaning towards buying premiums. What do I want to do? Limit theta decay. Well, if I want to limit theta decay, then I want to go out further in time, right? So when you're buying an option, a trader wants to limit theta decay. When a trader sells an option, they want to exploit theta decay. Well, I already talked about this. We're starting to get closer and closer. I know you got that idea of the call calendar up there on this shelf. And these are both very important. Why? Because we're going to exploit both of these, right? Why? Because we already talked about the inside of 35 days to expiration, right? We're right in that wheelhouse. We can see what happens. This is representative of the at the monies, but all of the options are going to kind of have a very similar decay to this. And we can see that our premiums really start getting eaten away inside of that 35 days. Further out in time, we see this kind of flatten out a little bit, right? So this is where I'm talking about. This is the buy zone, right? You want to buy premiums, and this is the sell zone. Because if you're selling premium, you want that premium to go down. You want to sell high, buy low. Out here, if you're buying premium, you're really looking for a directional move or hopefully have volatility be on your side, but you want to limit theta decay. You can't get rid of them. You can kind of just slow him down a little bit, right? So that's what we're going to try and do. And, with this strategy, we're going to be taking like advantage of both of those, as I mentioned. All right. So what vehicle do we use? The long call calendar, right? What spots are we going to want to visit? Well, we want to sell. Now, here's where we're going to drill this down. I like to use the out of the monies. All right. A lot of people will say use the at the monies on both the call. They're the same strikes. Okay. We have to use the same strike in order for it to be considered a calendar. If you're using different strikes, that's called the diagonal. All right. And we'll talk about those strikes and everything else in another webinar. But the long call calendar has the same strikes, but different expirations. Okay. Same strike, but different expirations. A lot of online stuff will tell you that you're using the at the monies. I use the out of the monies. All right. And what delta? The delta I'm using is basically a 45 to a 36-ish delta. All right. That's where I like to start on the nearest expiry, because that's where my real risk is in being tagged, and I want to get further away from the underlying, so I have a little bit more wiggle room to have on the upside. It also will help me down the road if I'm directionally right to make money. So start here. When we're talking about the strike location, I like to really go for that 36 delta. All right, that's the first one. If I actually think maybe even Goldman Sachs might even have a little bit further down to go, maybe a little bit more of a correction. And I might pick closer to that 45 delta, get a little bit more aggressive, because my theory or the thesis on this trade is that it's going to move down a little bit further, right? So I can get a little bit more aggressive with my my call location. But generally speaking, I first opt for this 36-ish delta to start building out this strategy. That gives me wiggle room to the upside, a little less wiggle room to the downside. So once we build this thing out, here you can see I used currently trading right here when it was trading at 289.37. I picked the 300 delta call in the near expiration, 300 delta call in the further expiration. You can see the April is the further here, February is the nearer duration. So I'm selling the one with the theta decay, and I'm buying the one that has the limited theta decay further out in time. And I'd like to try and get this to build out where it's as close as we can to get to make one, risk one to make one, all right? Yes, I'm risking a little bit more than what I'm able to make in this specific setup with the Analyze tab. But remember, this is analyzing it from the nearest expiration, all right, which is the one that we sold. Now, if that short call, goes off the board, it's worthless, and, we can get out of it for nothing, or it expires worthless and basically just disappears from our account, then we are left with that long duration, long call, right? So then all of a sudden my upside is exponentially higher, all right? Means I have really no I have unlimited profitability after the first one expires. During the life of this strategy, if it comes up and expires 1 penny below that 300 strike, then I would get the full max profit if I were to close it on that last day of trading. Only way to do that, obviously, is to get it to settle, this short call to settle 1 penny out of the money so it expires for 0. For one, I'm not going to wait that long. Two, I would probably have covered this trade as soon as I saw it come up there and click that 300 short call. That's most likely where I'm going to be pulling the ripcord on this trade for a winner. If it doesn't work out for me, if the underlying starts moving down, what am I going to do? Well, I already know my risk of getting into this trade. I'm likely going to ride it out, let that short call expire worthless. I know I have on a long call for very cheap. I'll probably ride that out for in and through the earnings if it's still a loser. All right. If it's a winner and I've let that short call expire worthless, I'm still long these long calls going into this earnings next time, I'm going to cover it before that earnings trade happens. I don't want to see that volatility come out after earnings, which is exactly what's going to happen. So if you are doing this setup according to what I'm looking at, then cover this trade before the earnings. All right. John saying, Goldman Sachs has already announced earnings, so the volatility will be low as we have fallen out of earnings. Yes, absolutely. So it is a good time to put on a calendar spread. It is a good time to put on a calendar spread because volatility is really low. Volatility affects those further duration options more. That's the one I'm buying. So I know I'm buying really cheap options. Yes, I'm kind of bending that rule, selling an option in the nearer duration with lower volatility, but I don't expect volatility to increase because we've just had the earnings. All right. I'm going to go run over all of this one more time really quickly before the end of it, but you get that? All right. So you guys have got this. First thing you do is you come up with your directional assumption. We talked about mine. I'm long-term bullish. Near term, I think we're going to stick right here. We just had earnings. There's nothing out there that's really going to make Goldman Sachs jump that I can see, that we can conceivably foresee. But heading into that next earnings, we can see the volatility expand. So yeah, I can take advantage of that. I'll go through that all again. The destination. This is the move the decimal 3 ticks, 1, 2, 3, or, if it's less than $100 stock, it's got to be less than 10 cents, right? On the bid to the offer. Now our environment, we went low volatility because I'm buying that long duration option. The duration, I want to sell at around 35 days to expiration. And I want to buy, somewhere out in time. It doesn't matter if it's the 56, 50 some odd days here. If we're inside the 35 days, it's going to be 50, 70. Those are kind of the expirations. But I really want there to be an earnings in there in the one I'm buying. As David alluded to, or John David alluded to earlier. Why? Because if I can buy my option in the one where that earnings is, I can almost assure myself that volatility in that option contract is going to expand heading into that earnings. And I'll show you on the chart in a minute how that works. And our strikes, I like to pick the near expiry option at around, I'm selling a call at a 36 delta. Okay. And then I'm picking the same strike further out in time. It doesn't matter, right? Because I know I'm picking the same strike. All right. Let's talk about our max profit. When the stock price equals that strike price at expiration, that is our max profit. And really, it's 1 penny below. We want that short call to finish just out of the money. If it finishes 1 penny in the money, we're going to have to worry about assignment if you hold on to this at it all the way through expiration. But when it's right there at 300 at expiration, that is going to be our max profit. Now, you guys, it is very difficult to figure out max profit, max loss, break even on calendars. Why? Well, think about all of these different levers and pulleys that are going on with volatility and how it affects our premiums, right? We're selling one, we're buying one further out. Everything is moving differently in those different months. So it's very difficult to figure out your max profit. And your max loss, we always know, because that is the debit we paid. It's not going to get any worse than that. But our break evens are going to be affected by this jostlation of the volatility. So, just know that our max profit is going to happen when the price is at our short strike at expiration. That's not where I'm getting out for a max profit. We'll talk about that on the exit strategy here in a minute. But our max loss is that net premium that we paid. And that is always true. It's the net premium we paid. Now, our max profit could be unlimited, all right, if the short strike comes off. Short strike comes off. Whether you get out of it or whatever, if it's only worth a nickel, why even have it on anymore, right? I would just get out. That's when I would leg out of it. But when that short strike, that near duration short strike expires, you take it off, whatever happens, you're left with that long put. Then you could look at it as being unlimited to the upside. Great handwriting. I look like a doctor writing. All right. Now our break even is basically a ballpark, not a very good ballpark to be honest with you, but you can kind of think of it as the option call plus the premium paid to the upside is your break even, and your option call option minus the premium paid is kind of like where your break even is. And that's going to be obviously at expiration too. So but it all will be very convoluted as the volatilities are acting differently in these different option contracts, right? There's too many variables on the floor, but this is kind of the floor trader hack that we kind of look at. And to be honest with you, it is not the best of my floor trader hacks, but it is a ballpark. And it's usually much more conservative than what is in real life. I'm basically telling you your break evens are here. Well, we know our break evens are really here. So it's a very conservative break even kind of paradigm. It is usually much better than that, but I'm just trying to give you guys something to wrap your head around to keep your powder dry, all right? Call option minus the premium paid for the option on the outright. Yeah, it's just giving you a ballpark as to how far this can go, because basically what happens is if the underlying goes down, right, if the underlying starts trading downward, what happens to our short call? It starts going down in value. That's good for us. That makes the spread better. So as the underlying goes down, that short call is helping us out and smooth out our loss, all right? And as the underlying moves higher, yes, our short call does start gaining in value, and that hurts us, but that long duration call is going to be helping us more so, all right? And that's going to smooth out that curve on the other side to make it look like what we were looking at on this specific page, right? It's got that smoothed outline to the side there. All right, so let's talk about our exits real quick, and then I'm going to come back to your question. I thought I saw one in there. So how do we exit? How do we exit the long call calendar? Might as well write it out. Long call calendar, right? So long call calendar, we know we're picking our strikes, and we're selling the 300 call. We're selling the 300 call in the near duration, and I'm buying the 300 call in the further duration. which is actually the April, right? And this is the Feb, all right? The near Feb and the further April. I'm not talking about the weeklies here either. Now on a winner, I'm looking at a 30% increase in that debit I paid originally, all right? 30% increase in that debit I paid. I'm looking to get out of here. If the underlying goes down and my short call expires worthless, or I take it off for a nickel or something like that, I am probably just going to ride this underlying out for that loss, or try and sell some other calls against it to lower that overall cost basis. I have no problem. Like in this one, we're in the Feb, go out to the March and sell some 300 calls or something like this. If the underlying is going against us, I have no problem with you doing that. I would not go inverted, meaning I would not sell a call below where my long call strike is, right? Long call strike. I would not go inverted. So 30% increase, and if you have a higher risk tolerance, I have no problem you saying a 50% increase, all right? I wouldn't go any lower than a 30% increase in the debit. So you can kind of pick those, write it down though, stick to your guns, write it down. Why? Because that'll keep you more mechanical. If you are wishy-washy, you're going to be less mechanical. You're going to be more inclined to break the rules. I don't want you to do that. So for me, I'm going to go for the max loss. If you guys don't like that, say a 50% reduction in that debit paid, right? So it went from, in my case, $7, it goes down to $3.50. Maybe you'd say, all right, I'm out of it, especially if you are a newer trader. But I have a high risk tolerance, so I don't want you guys necessarily to follow my losers, but I like to play out the probabilities. I'm going to play this one, and if it is, worthless, if this 300 call is worthless going into their next earnings, then I'm just going to let it ride. There's no sense in taking it off then, right? I'm going to take it for the upside. So let me pull up a trading platform real quick and look at this example, building it out from start, like how we would normally go through this, right? So if I were to go through, and let's just say I'm going like this is what I usually do, to be honest with you, when I'm flipping through charts and stuff like that. I just go like this, and I don't see any setups really there. JP Morgan kind of looks like what Goldman Sachs is doing. Maybe if it didn't fit all the rules and I was getting too many yellow lights for Goldman Sachs, I would look at something like JP Morgan, right? Because it's a bank. They've already had their earnings. Something to note here that's not going to be showing up on this platform, but this one it will. You can see the earnings are out here, right? And that lands in that April contract, right? I've got a clean month here other than this. I just had earnings, so I don't have to worry about that. That's what John was talking about with the low volatility. So that's why I've come up with my assumption. Now, what I'm talking about with volatility expanding, you can see this is their earnings. You can see volatility likes to expand going into that earnings. After the earnings, we get that volatility crush. So it comes into earning. Well, we got a volatility spike there, but I would be selling the volatility up and around this area outside of the earnings anyway. Again, you got that volatility spike and it came out, all right? So when we come into earnings, we generally see that volatility come into the market, and then right afterwards, we get that volatility crush. And when we're talking about this volatility coming out 5 percentage points, that can be pretty major, all right? So I've come up with all of that stuff, like 5 times 33, right? If this increased by 5 percentage points, 5 times 33, what do we get? That's about $1.65, right? Well, that's how much came out when we saw that volatility come out here on that earnings, 5 percentage points. So $1.50 came out just on that volatility coefficient, all right? So we could expect that volatility increases by 5 percentage points. These would increase by that $1.65. So right? I've come up with my directional move. I come over here. Is it option tradable? I look at this. It's over $100 or $100 stock. So I move the decimal 3 ticks to the left. I'm looking at 29 cents. I need to look at the bid offer, make sure that during open market operations, it pretty much fits that rule. And we showed that in the screenshot. It was a bit of a yellowish green light, but a green light, I'm going to call it. Shoot. One thing I forgot to mention, and it looks like nobody's left, thankfully. Whew. Another major one here on volatility I forgot to mention is we don't want a major difference between the two volatility coefficients, all right? And when I'm talking about that, I'm talking about implied volatility again. But specifically, this implied volatility, the Vega, right? I said was implied volatility, right? This Vega to the one that I am buying, all right? I'm selling a call here and I'm buying a call here, all right? I don't want a major difference between those two, all right? So what I'm talking about with volatility here, which is why I wanted to throw this out over here, I think it was. Actually, let's take a look at this one. I'm going to go back to this. I'm going to erase everything too. Erase all the ink. Don't leave right now, you guys. I got something very important to say. All right. So those differences between those two volatility coefficients. Actually, I'm going to pull up the platform here again. I'm a little frazzled. All right, let's pull up this platform because I want to specifically talk about this one. All right. So I said we're buying a call here. We're looking to buy this call, right? I'm buying the 300 call actually, but I'm buying this call, and I'm selling a call down here. The difference between this one and the one that I'm buying, which is the April. All right, my rule for this is less than 3% difference, and this is a less than a 3% increase, okay? Being the one I'm selling to the one I'm buying, less than 3% increase, during our whole roadmap, that would be then a green light. All right? Basically, if it's 3 to 5%, we're looking at a yellow light. If it's greater than 5%, then I'm looking at a red light. And that's the difference between these two, okay? Right there, you can see it's right around 3-ish. So another bit of a yellow light, all right? So you're going to have to take that in mind as well. But we don't want a big, massive increase. And a lot of times you're going to see this one have much more volatility in it. Why? Because that's the one that has earnings in it, and it's the expectation of volatility going higher. But we don't want to sell this premium for very low volatility or extremely cheap pricing and then start paying up for this one, right? That's kind of counterintuitive. So we don't want a major difference because I don't want to be selling super cheap premiums and buying super expensive premiums. I don't want to get into that situation. I've already explained why, right? So to avoid that, make sure when you're looking at those implied volatilities in this specific one that there's not a major difference. And you can easily find it where it can be 5-10 percentage points differences. Don't get involved in that situation, all right? This one's a bit of a yellowish light, but I'm going to go with it for all the other reasons, for lack of a better example, Wolfman. All right, so does that make sense? So then what I would do is I'm coming in, I'm looking for around that 36-ish delta. I'm always going to probably default to the further away. And then I'm going to look at that April contract because that's the one that has that earnings in it, right? We saw the earnings are right here. So I want to take advantage of that. And then I'm going to go out and buy the 300 calls here. So you can see my strikes are the same, right? I'm selling one, buying the other for a debit of $7.28. Now remember, the one of the basic rules is our option contract multiplier. Every one option contract is equivalent to 100 of this underlying. So whenever we're looking at the option montage and we see these pricings, they look super cheap, but you got to remember, you got to multiply them all by 100 for every one lot that you do. Okay, that's the option contract multiplier. Why? Because every one option contract is embedded inside of that one option contract. There is 100 of the underlying. So it's an option contract multiplier. All right. So we've got to multiply that by 100 contracts. That makes sense for everybody? Building that out, you can check out the Analyze tab. It's going to look like the Analyze tab we had before. I don't know why it's looking like that now. This one, April. Oh, that's a really old thing. So there you go. We can see that, you know, I can squeeze it up. You can see that I can't lose any more than that debit I paid to the upside or the downside. My max profit is very close to the risk one, make one on the Analyze tab there. Okay. Major thing to remember though, don't get involved in a situation where these are really blown out, the difference between the two implied volatilities. Okay. So that's a key I forgot to mention back here when we were talking about volatility. You don't want a major difference there. Why does my pen disappear? There. I don't know what was going on. Any other questions real quick? Shouldn't you be selling the earlier expiration and buy the later expiration? Yeah, isn't that what I was doing? Selling. Didn't I do this? Sell this one and buy this one? I'm selling the February and buying the April. I thought you wanted higher Vega on you. Well, James saying, I thought you wanted higher Vega on the short call and lower Vega on the long call. Yes, if you ever have a situation like that, you definitely want to take advantage of it with the calendar, okay, or the diagonal. That would be a perfect scenario, right? What James is saying, you say, don't you want higher volatility here and lower volatility here? Yes, you do. You aren't ever really going to often get that. There are going to be occasions where you will, but often you won't. Why? Because volatility affects the further duration options more. So you can see usually it kind of goes up a little bit there. But yes, if this was higher, that is the perfect scenario. Just make sure there's no earnings in this one. That would usually indicate there's an earnings in the one that you're selling. All right. So you want that clean month with this strategy. All right. But yes, if you ever are flipping through the option montage and you kind of come up with a similar assumption to this, and it just so happens that front month is higher in volatility than that further duration month, that is a home run. Like I have done webinars where I've had that happen and I've given examples on it. But very rarely, you know, I've been lucky to have that happen. And during that pandemic, and even coming out of the pandemic for a while there, we were seeing volatility in the front months higher than the volatility in the back months. So it was absolutely a perfect opportunity to do something like that. All right. So great question, James. But usually what you're going to have happen is see that volatility rise out on the, if it goes down, yeah, you don't have any question. But if it starts to go higher, then you just want to make sure you're not getting that spread too far. Can you use this to finance long calls, say 35 days before earnings, when you believe that the next earnings will be a blowout after the short call expires worthless? James, yes, you absolutely could. Now, if this trade was a nice winner, and if I was trading Goldman Sachs during their next earnings was higher than 300, that short call obviously is expired worthless. Everything's gone great. I'm heading into earnings, right? I'm a couple of days before earnings. I'm trading above 300 somewhere. I don't care where it is. I'm getting out of it. I don't care if I'm bullish through this next earnings for Goldman Sachs, right? I would cover this trade. You've done as good with this trade as you basically can. You've got the volatility expansion for you. You've got your directional assumption. All of those things worked out. I would close that trade and then put on another high probability trade for that earnings, okay? Why? Because if Goldman Sachs beat on earnings, and even if the underlying stayed where it's at or even moved slightly higher at the next earnings, that volatility crush coming out, we could see 10 percentage points coming out. That'd be like $3 coming out of my premiums. All right. I don't want that to happen to you on a long option, because that volatility crush can completely erase your directional move. Right. So yes, if volatility is higher in the near duration, that's great. Just make sure it's a clean month. There's nothing going on. They don't have something coming out like earnings or an announcement or, biotech these days, a trial result, right? We want a clean month in that regard. But with this, we know we have a volatility event happening in this April contract. So I definitely want to be buying this one and taking advantage of that expansion and volatility heading into the earnings, which is what we would generally expect to see, right? I'm going to answer you. I see a couple questions. They're really long, so I'm going to wait till right after this, and we'll go over those questions. So if anybody else wants to stick around, then I'll dig into those. All right, guys, I'm throwing a link in the chat window right now for you guys to take advantage of this. We've been talking a lot about earnings. You guys, seems like this is right up your guys' alleys for sure. And this is our offer for earnings, okay? We are heading into the thick of earnings. As a matter of fact, I just put on my first earnings trade today for this cycle. I talked about it, selling Intel puts. I'll talk about that tomorrow in the daily market commentary, win, lose, or draw, see how that worked out. I haven't even looked at what has happened with Intel's earnings after the close. But here is the link. We have option courses for earnings. This long call calendar is going to be in there, specifically talking about how to take advantage of this in and around earnings as well. A little bit more detail around that. This is just touching on how we would implement this strategy. But you get instant access to the entire catalog of all my earnings trade strategies. You're going to be able to easily spot the best strategy for the biggest moves. You're going to understand how to turn those probabilities in your favor. Also, you're going to be able to find out what my favorite option strategies are for earnings as well. So I threw all of that out and a lot more, all kinds of content there for 36 bucks. I mean, if you guys listen to one of these guys on mainstream media talk about their earnings options trade, I can tell you, you're going to lose $36 on just one trade alone. So I'm going to save you that angst by getting you guys out there ahead of the game immediately, if not sooner. But like I said, the link is over there in the chat window. You guys can get first access to that. Otherwise, if you're watching this on tape delay, you're going to have to pause the video, punch that into your URL. This is the page you should be getting to if you're clicking on this link to get all access to all of those earnings. I'm talking about condors, call spreads, diagonals, before earnings, after earnings. How many days in advance do you set up an earnings trade? I'm going to answer that question for you in this webinar. So make sure you take advantage of that for 36 bucks. Here again is the link. You can reach out to us at 310-598-6677 or email me at trading@protraderstrategies.com. Finally, make sure you guys know your risk and what you're getting yourselves into. We are an educational company. I'm not trying to get you guys to do the same directional assumptions I am. What I'm trying to do is teach you guys to think for yourselves so you understand these options intuitively. So it just makes sense. Why would I be going and buying a call before an option or before an earnings and try and take advantage of that directional move? If I am right, I still might lose money. Even if I'm directionally right, I might still lose money on buying an option, a call or a put, depending on my move, because of that volatility crush. So I show you how to avoid all of those mistakes in this course. So make sure you guys take advantage of that. Like I said, it's over there in the link. And we'll go over some of these questions. Thank you, Alexander. Appreciate the kind words. All right. So I thought you wanted higher break. I answered that one. I erroneously said it backwards. Sorry about that if I did. All right. So if the price falls below the strike, that price on the short call will become cheaper to buy back. Yes. So the short call, if the underlying goes down, if my short call and the underlying goes down, my short call, remember, a negative move in the underlying makes my deltas negative. The deltas subtract from the premiums. Remember that? So my premiums would become cheaper. So if the underlying started going down, which is kind of what I, believe it or not, ultimately kind of wanted to go maybe a little bit down and trade sideways so that that short call will get cheap quick, right? I want to be able to take that short call off. This is one of the few strategies where I'll leg in and out of it, or not leg into it. I won't leg into it. I'll leg out of it because that short call, once it's worthless, or if it's worth a dime or a nickel, maybe even a quarter, if I sold it for $5 and it's worth a quarter, I'm taking that sucker off. It's just not worth it. I'm playing around with 25 cents or $25 out of 500. I'm going to take that short call off and leave my long call on, all right, and play it out that way. Hopefully then we get that reverse. Does that make sense? Or I would roll it out, yes. Or you could roll the Feb to the March, since I'm in the April way out there, go to the Feb to the March, lower my overall cost basis. If it was kind of just trending sideways, I wasn't worried about it breaking out any. I would just roll that out, collect another credit. Yeah, absolutely. That increases my break even and my overall profit. Use this strategy, finance long calls. I can't think I answered that one. It popped. 35 days before earnings. And then when the earnings, yes, finance, short calls, 35 days to expiration, finance those calls that I'm holding long duration, finance a lot of that debit I would normally have to pay for. So that's what I'm trying to do, is lower that payment I have to put out. Also, if I can nail it where I can put that long call in an earnings, then I get that volatility expansion. If I'm directionally right, all of those things work in my favor. All right, James, did I answer that for you? You went kind of explain why, or kind of went past explaining why you close out the trade after expiration of the short. Okay, hold on. All right, so I think, all right, so I'm selling a short call, right, in the nearer duration options. So I'm selling that one. Now, I want that short call, maybe shooting from the hip here, guys, on explain how I'm going to explain this. So if I'm selling this short call, right, I'm collecting $5 and something for it, and then I'm going on buying the same one. So if I were just to buy this one, it would cost me $12.75, but I'm selling this one to help me finance it, right? So I'm only paying $7.28. Now, if this option that I sold for $5, the underlying goes down, right? If underlying goes down, let me do this. Where is my theoretical? Let me hit reset on this stuff. All right, so let's just say the underlying starts going down in value. It goes down by, say, $5. All right, so it goes down by $5. Volatility doesn't adjust at all. All right, so we can see what would happen to our premiums. If it went down by $5, oh, plus $5. I went down by $5, negative $5. So if it goes down by $5, you can see that my premium, right? There. Did that make it adjust? There we go. So we can see that that premium decreased, right? So if I can get this one to decrease to 0 and maybe say days to expiration, I can change here. Let's just change the days to expiration to, what are we here? Jam Feb. I want to make sure I'm not. So change the date. We can even see the premium's gone down even further. So you can see that this premium is rapidly decreasing. So if I can cover this for like a quarter or something like that, as that time goes on, then I'm going to do it. I'm going to try and get out of this one and then leave this one on. I might go into the March and look to sell some of these 300 calls or something like that. All right. Does that make sense? To lower that overall cost basis again. If it just completely traded sideways, you know, on the what was it, the 19th I was looking at for February. Let's just say it's like February 17th, a couple of days before expiration. The underlying's moved down by $5. We could see that our 300 calls are worth 6 cents. These options on these are still worth, have lost value, but here we go, have lost value, but are still retaining a lot of that value through theta, right? Because we didn't adjust volatility, just the market move. I could go out and sell these March 300 calls for probably around $4, lower that overall cost basis again. So ultimately, I want this short call to expire worthless and leave on these long calls. Oh, I got that, but I thought you suggested closing the long calls before the earnings. Don't hold it through the earnings. Right. Yes, I don't want you to hold, like, for instance, I got out of my short calls here, right? So I got out of those short calls. Now, I don't want to hold this on during earnings. Why? Because of what happens with volatility after those earnings events. So the volatility crush that comes out after earnings events, we can see that this, right after this earnings event, dropped from 48 down to the next day to 35. Let's just call it 38. All right, so 10 percentage points. So in one day, if we were looking at it during that option contract, right? If it dropped by 10 percentage points, my volatility was right here, and then I'm talking about losing 10 percentage points here, right? So I would lose, if I lose 10% after the earnings, this would go to 21.22, right? Well, if I lose 10 percentage points out of these premiums over here on the calls or the puts, whatever it is, it doesn't matter. For instance, if I, you know, let's just say we're at the money or whatever, they could have been in the money, who knows, wherever they are, it's going to decrease by this vega after that earnings. So I can essentially say that if my premiums decrease for every 1 percentage point by the corresponding vega, 33 cents, if it decreased by 10 percentage points, then that's $3, right? 10 times 33 cents is $3.30, right? So these premiums, nothing else changes, would decrease by that $3.30. So they would go from $9.60 to $6.30, right? How do I make up for a $3.30 deficit on the vega? Well, that would mean I would have to have a move to counteract that to the upside, right? It's like a $7 move to the upside, right? I have to make $7 to the upside, that delta, right? I need 7 times the delta in order to make up for this 10 times the vega. So unless you think that it's going to make like a $7 move in your direction, that's why I'm saying cover that. You've already made your money. Cover that. You've taken advantage of the highest premiums you're going to see, right? That's when you sell, when those premiums are at their highest. One thing we know is right before earnings, premiums are at their highest. So cover that trade and then look at one of the other, you know, if you have a directional assumptions, one of the other earnings trades that I have. All right, the earnings option strategies. All right, got it. Perfect. Earnings beat. Chances my long call would increase more than the loss in Vega. Yes, you have to have that. And that's why I want you to avoid any of those uphill battles. And that's one of them. That's why I was really pounding that drum. Don't hold on. Anytime you are long options going into an earnings or a binary event, I would cover those because that volatility comes out. You have to exponentially make up for that in your directional move. All right. And that's what, in this case, if you're a bullish in Goldman Sachs right before the earnings, I would say, well, then you would be selling a put spread or a short put, right? Because in this case, right, I know volatility is coming out, so that's helping me. I could have a $7 directional move against me in that case and still be okay. That makes sense? I'm trying to turn those probabilities in your favor, especially with the earnings forces. There's a lot of people, I'm telling you, people on mainstream media will not be talking like this. And they have their own reason for doing that. But at the end of the day, they're really not setting people up for success that way. All right. All right. Thank you guys all. A lot of people stuck around that extra half an hour. I appreciate it. I appreciate all the back and forth, you guys. You guys drive the content. Like I said, you guys maybe remember about one of the most important aspects of the long call calendar, and that is the difference in the volatilities, the implied volatilities between those 2 months. We do not want a major spread there. All right. Thanks, guys. Appreciate all the kind words. All right. You guys take care. Nobody else has any questions. Thanks, Dan. Bye for now.